You are getting your health insurance through your employer. But is your plan fully funded or self-funded? Yes, you should know. Welcome, I am the Medical Bill Whisperer, a previous billing manager turned patient advocate. I am committed to bringing answers, insights, and solutions to patients like you. So, should you know what the difference is? Yes, as it will affect your benefits and remedies in case of issues. So let's see the differences, pluses and minuses, and how to best take advantage of each. Self-funded plans are also called ERISA plans. They are plans whose expenses, such as paying claims for the members, are paid by the employer, usually a very large company. It is that company, not the insurance, that assumes all the financial responsibilities and risks for covering the employee's claims. Those plans do not rely on an insurance company to determine benefits, but instead let the employer set parameters for coverage, extension or extent of benefits, and exclusions. The insurance company whose name is on your card or explanations of benefits acts only as a third-party administrator, managing the plans, processing claims, issuing EOBs, handling appeals, providing a network of contracted or in-network providers, but not actually paying the claims. Although the insurance is involved in using the terms of policy to process your claims, it has zero authority or power to change, extend, or limit them. It acts on behalf of the employer, not on its own or its members' behalf. Hence the common complaint of lack of assistance and support by employees. Those plans are administered and supervised by the Department of Labor, a U.S. federal agency, which handles also last-degree disputes and appeals, as we will see. On the opposite, fully insured plans are those bought on the open market from an insurance company or an agent, either as a standalone plan or within a group of employers joining forces and dollars to reduce costs and get more affordable premiums. In exchange for those monthly premiums, the insurance company takes on the full responsibility and costs of those employees' medical claims. The insurance company is the one to determine the coverage and benefits. It is the one setting exclusions based on its own standards or criteria. The employer paying the premiums has no authority or power over the terms of coverage or exclusions. Those plans are administered and supervised by the state's Department of Insurance, which handles last-degree disputes and appeals. Self-funded plans have pluses. First, 3 levels of appeals in case of disagreement with the way your claim or request for an authorization was processed or denied. An appeal is the right to demand a review of an action or decision that turns detrimental to you, the member. The first 2 levels go to the insurance, the third to the Department of Labor's ERISA Review Board. As the employer determines what is a benefit or not, HR or upper management can overrule the terms of coverage and easily authorize exceptions or extensions by ordering the insurance to cover a service otherwise denied. For example, HR or upper management can approve your experimental cancer treatment or extend the number of ABA therapy visits for your autistic child beyond the 24 per year that the policy otherwise allows for. Because this policy is flexible, it is easy for the company to address specific needs for the population of employees and their demographics. For example, A company employing younger, healthy folks could appropriate less dollars towards cancer treatments or heart supporting prescriptions and instead allow more towards preventive care or stress reduction. And what the policy will or should cover can be a bargaining tool at the time of negotiations. If a policy can cover more services, it could mean less of a salary increase for employees, but they would then have to dig less into their pockets to pay for non- or undercovered health services. Self-funded plans also have minuses. I mentioned the ERISA Review Board. They rule the third-level appeals, however, usually only on the terms of policy and whether those were ignored or mishandled. They usually do not rule on issues relating to medical necessity, access to clinical care, or billing issues. In those two cases, the two levels of insurance would be it. As the insurance itself holds no authority to change the terms of coverage, it can offer limited support or options when special circumstances or medical needs occur, unfortunately leading to denials for appeals based on the parameters set by the employer. And also, those plans are not always mandated to follow state or federal guidelines and can often opt out. Only when the law clearly includes such plans must self-funded plans comply. Now, fully insured plans also have pluses. Now, they only have two levels of appeals. The first with the insurance, but the second is with the state's Department of Insurance, where the plan is registered, not the federal government. And the insurance has more flexibility to issue special authorizations, exceptions, extensions of benefits, or even higher payments based on special circumstances, medical needs, lack of in-network provider, delayed access to care, new medical policy, treatment or prescription newly approved by the FDA, and more. Policies can be stretched with documentation and evidence. As for the minuses for fully insured plans, well, if you only have two levels of appeals, don't waste them. And depending on the state, that Department of Insurance can be more or less favorable towards patient. California, for example, is very patient-friendly. Texas, not so much. The state where the plan is registered as a business entity, not necessarily your state of residence, supervises. So if your employer is registered as a business in more than your home state and buys a policy in another state where, for example, it has its headquarters, it is that other state that would handle second-degree appeals. Premiums and coverage are not based on a specific population and therefore can then end up costing more to those not using many medical services. And the choices of group coverage or plans can be limited in certain areas, especially if the smaller company you work for only does business in one state. Now, there are some tips to stretch the policies and get you some advantages. For self-funded plans, don't necessarily turn to the ERISA Review Board for clinical-related issues, as they will usually reject those requests. These are not doctors or medical specialists, but administrators whose job it is to enforce general terms of policy. Instead, turn to your HR or upper management if an insurance hands are tied. Once your employer sends the okay, the insurance can issue that additional payment or authorization. And if you and your colleagues have too many complaints about the insurance company administering the plan provisions, do complain with HR, that insurance can be fired, as they are getting paid to provide supportive and helpful services to you. If you have a fully funded plan, know your policy or at least the headlines. You can check out the summary, it's usually 3 or 4 blue pages, or even the entire evidence of coverage document. But especially if you need to use something in there against the insurance. Trust me, it happens more often than you think. You should also know the major laws out there, the Federal No Balance Act, and also any state's main patient protection law, for example, access to care. Your insurance may not follow these mandates by willful disregard or incompetence, and that's where an appeal would be successful. And also, give a look at your state's Department of Insurance website. It can give you info on legal mandates, help you file a complaint or a second-degree appeal. And you can learn more about the quality rating of your insurance. So first of all, know your plan. Ask HR or your insurance company, as getting stuff covered and paid for correctly depends on that information. There is no point wasting time and efforts on the wrong regulatory agency or administrator. I thank you for watching. Your likes, comments, and subscribes help this little channel grow. So thank you.